Let me start off with you, Ian. You've been in Singapore for a while, looking after LIM's interests. How difficult is it right now to raise capital? How difficult is it right now to raise capital compared to a few years ago?
Well, I think as today's sessions have pointed out, it's very difficult. There is a great deal of caution, quite properly, amongst the investment community. There's a great deal of nervousness, and there's a hesitancy to commit if there's no time imperative to commit. So people are taking far more time than they used to take, and there's also a nervousness about going first. So getting a first close, I think, is the biggest challenge at the moment for any manager raising capital. In my mind, and I have been here a while, I've been in Singapore 18 years and raised many funds during that time. To me, this feels very much like 2000 to 2001, which was immediately or shortly following the Asian financial crisis, when there was similar caution and similar hesitancy to actually commit. In those days, we were raising what we called then the Asia Recovery Fund, and I have to remind our own people that in those days it took us 2.5 years to raise a $240 million fund. People that weren't there then remember what it was like in 2007, where it took less than 6 months for us to raise a $3 billion fund. It's just not like that anymore.
Is 50 the new 100 when you're raising capital, or is 20 the new 50?
Well, definitely 20 is the new 50 and 50 is the new 100. Everybody that was a $50 million investor is struggling to get to 20 to 25 now, and everyone that was a $100 million investor is rarely going beyond 50 now.
Charles, why do you think there is so much caution?
People are worried, I guess. Well, we've been raising our second fund really since last June. We had a fairly compressed period of time in which to do it. We've started to take the view that whenever we're raising capital, there's a global crisis of some sort just around the corner, because it happened back in 2007, 2008 as well. But I think in general people are simply averse to risk. I think the illiquid nature of our business makes it easy for people to put decisions off. I don't think there's a lack of appetite for the opportunities that are presented. But I simply think that there are various internal factors in organizations that coalesce around inertia. And the penalty, as I try to explain to our team, the penalty for waiting is not discernible, at least in people's minds. I think there is an opportunity today in the market on the transaction side, but then translating that into an argument for moving relatively quickly on the investor side, that's a lot of heavy lifting. And so paradoxically, the opportunities have never been better, transactions in terms of what we see on the transaction side, and yet the inertia on the investor side is understandably something that's very hard to overcome.
Yeah, I am indebted to Andrew for putting Australia at the top of the top of his list as well, which is very nice of him to do. Joshua, we were talking about the delay or the time taken that Ian was mentioning. If you agree with that, to convince an investor to invest, how does that manifest? How does that manifest itself in the work that you have to do to convince an investor to put their funds with you?
If I knew that, I probably wouldn't be sitting here right now, actually. I'm sure I'm not the only guy out there raising money that wants the bar to open right now, especially after this morning's conversation. Very uplifting. But it's hard out there. There's no question about it. It should be hard. I mean, there's a lot of uncertainty in the world today, as we all know and as we've all heard. But I agree with what Charles is saying. I think that the silver lining of all of this is that the lack of capital that's actually going into the space is creating tremendous opportunities. And, the supply and demand dynamics, not just in development of real estate, but in the capital going into the asset class. And we were all talking this morning, I mean, some of the deals that are getting done are extremely attractive, relative to convincing an institutional investor, that's just a difficult challenge, and it really depends upon the individual situation. So Charles was talking about, the penalty to wait. From a U.S. perspective, and you look at kind of the pension funds, for example, in the U.S., they have actuarial hurdles that have been rising, and now it used to be 6%, now it's 7.5%, 8.5%. You can't get that with a fixed income allocation today, and you can't project that in an equities allocation today. So you've got to be driving for some higher yielding types of returns. But on the flip side, there's this concept of risk, and I think that when you talk about capital raising for real estate in today's markets, there are a couple of things that help to, I guess, expedite the decision making, if you will. One is obviously a legacy relationship. And I think we were all talking before that, re-ups are probably the lowest hanging fruit, if there is such a thing. I think also, and this is interesting, is that, I think seeded assets are much more attractive once again, and that when you have some more visibility into your funds, it's less of a risk. Whereas 3 or 4 years ago, it really was a liability, because I think people viewed kind of existing assets as kind of waiting for the knife to fall further. And it's creating also tremendous pressure on the GPs relative to terms. And there obviously the pendulum, which swings every now and then, has swung back into the LP's corner, and there's a tremendous amount of negotiating leverage now they have in order to get to that first close, in order to convince those guys to actually move. And I think GPs, and we see it, I'm conflicted, because on the one hand I'm investing and trying to hammer the GPs, and on the other hand I'm raising capital and trying to convince my investors that we need to make some money. So, but the LPs have a lot of leverage right now, and the GPs are pretty willing to negotiate.
Thank you. Tom, we're hearing quite a lot about platforms, and we've had Blackstone buying Valad in Australia, Morgan Stanley buying Orchard, LaSalle buying Trinity, and Forum buying Veneto, which was a little deal, but seemed to make sense for them. What do you think the value of the platforms are raising capital? Is it something you've got to have?
Yeah, absolutely. I think one of the things that the crisis has brought on, I think, just to link it to the last discussion, is there's an overhang. Given there was so much capital raised prior to the global financial crisis, the reality is that most of those capital commitments have not been, well, either the commitments haven't been released, or certainly the assets haven't been disposed because of the lack of liquidity in the markets, and therefore there's a big overhang where investors that would like to re-up with managers actually haven't had their capital back from them. So that's an issue. Speaking specifically to your point, I think there's, on the one hand, you would expect in markets like these for there to be a lot of new players come into the market. I think it's very difficult for new players and new entrants, or even if you're an existing platform, it's very difficult to start a new business now. We spoke, I think, huge and very costly to overcome. But also, I think, when you're an existing platform and you're looking to grow, acquiring other platforms is not always the best way to go. I mean, many of the platforms actually have a lot of legacy issues within them, and so we certainly have been very cautious about that, because what we need to do is maintain focus, certainly on our existing clients. And you've got to be very comfortable, if you're going to take on a new platform, that you have the capacity not only to service your existing clients, but actually probably resolve some of the issues in the platforms that you're acquiring, because there's probably a reason why those platforms have come to a point where they're on the market, i.e. there's issues to resolve in them.
Thank you. Justin, the branding issue comes up sometimes in the context of platforms to make yourself bigger and better and shinier and perhaps more appealing. How important do you think the branding is. You have a very well-known brand. Everyone on this panel has got a brand that's known. How important do you think it is to have a big brand? We've got Blackstone just having raised $13 billion. Is that due to the brand? Is that due to the returns? What do you think is going on there with branding, and how important will it be, or how important is it?
I think obviously a brand is very important, but there's a number of other matters as well apart from the brand. And I think, first of all, the brand in itself means that it stands for something, and by that is that, you know, basically a untarnished reputation. There's far more behind the brand about integrity, the way that the actual fund manager or investment manager treats clients, investors, in terms of making sure that they always put their interests first, that they're always transparent, accurate in terms of reporting, and particularly, I think, given what we've gone through with the financial crisis, that they acted very responsibly through that period. So if you haven't done that through that period in terms of being quite upfront with your investors, that you haven't actually put their interests first rather than the businesses, then I think you're going to be in real trouble trying to go out there and raise further equity. But perhaps it'd be an oversimplification to say it's all about brand, even though it's very important. I think the other thing is you've still got to have an established platform. You could be, have a fantastic brand name, but going into a new market, and if you don't have that established platform, I don't think you'll raise money. Secondly, I think you've also got to have a track record. And I think that was one of the things which we see very much today, is that trying to do a first-time fund is very close to suicide, I think, because you just don't have that track record. And indeed, an investor, they don't want to take that risk by going with a first-time fund, even if you've got that platform, even if you've got that brand name.
So are the barriers to entry increasing for new GPs, do you think?
Absolutely. So in fact, as a GP, we should be very happy if you're actually well established already. But again, that's probably an oversimplification, because we don't see that there's a lot of capital there really to raise. And there's an interesting point which I saw. If you look at asset allocation surveys and investor intention surveys, for example, with European institutions, it is actually slightly up, and in the US it's even increased. However, there's a complete disconnect then with capital raising. So I think that promises well for the future, but right now it's very tough for GPs.
Joshua, Tom was mentioning regulations before. There's a little bit of regulation going on in your country. How is that manifesting into raising capital and the way you go about your business and the cost of doing business, which someone's got to pay for?
Well, I think that the regulation discussion is probably a whole nother panel for sure. There's a lot going on right now, and I think the governments are stepping in to try to prevent the messes that were created in the past. And I think as a GP, it's creating, friction, as it always does. And there's a law of unintended consequences. And in the U.S., Sarbanes-Oxley, Dodd-Frank, all these things are really Volcker Rule. It's really changing our industry, the new RIA regulations. In Europe, we've got Basel III and Insolvency II, and it's changing the dynamics between the GPs and the LPs. And on the one hand, I think the intentions are all good. You can debate on, those unintended consequences. We were talking this morning. I got a letter from one of my investors last week that wants new language put into our side letter about investing in Syria. We don't really have an interest investing in Syria, but because of public pension plan and the laws and the trade bans, they want it documented, and this is just it causes it's a pain. Of course you have to do it, but I think that's happening, and limited partners, especially on the public side around the world, are having to deal with this.
Thank you, Charles. Just staying with capital for a while. New places to look for capital.
I'm sorry, Roy, I didn't catch that, sorry.
Yeah, I just wanted to ask you about new places that we can look for capital, or that you guys are looking for capital. And I wonder if you'd tell us a little bit about emerging markets and how important do you think they are, and what are they?
As a source of capital?
As a potential source of capital, yep.
I think that's something that's going to require a great deal of patience and I think in time. I'll be slightly contrary and say that I think what has served us best, but we're a boutique, so we're not going out and raising billions of dollars, is to go back to people who know us, people, whether they were in our first fund or not. Reputationally, personally, my partner and I, we spend a lot of time not only cultivating but maintaining relationships, not just showing up when it's time to raise a fund. I think people, and maybe I have a slightly different view. I think this whole notion of brand is overstated. I think what matters more is wherever you raise capital is the way you approach your business. I think the consistency you apply to the relationship building through good times and bad. I think the transparency of your business, I think that's very, very important. And so ultimately, I think our business has become a lot more difficult in the last 5 or 6 years. And I think going to emerging markets to raise money is going to be something that's going to require dedicated effort and probably is going to detract, in my opinion, from what I am paid to do, which is to get my capital out, to raise it as quickly as possible, and then to get it out judiciously and prudently over the course of the investment period.
So where would you be heading? What are your top 2 destinations to raise capital, emerging destinations?
In terms of raising money?
Yes.
I just don't, it's just not on my list of things other than obviously, Singapore is not an emerging market. Wherever there are pools of capital, family offices in Asia are I lecture actually at the Singapore Wealth Management Institute, and I spend a lot of time with private bankers who bank Indonesians and Chinese and Indian nationals. They have no interest in an illiquid product, absolutely none. What they want is their money back in 30 days, probably 15 ideally. So almost all the products that the private bankers are interested in feature liquidity. I think family offices in Europe, Switzerland, Germany, to some extent France, are prepared to take illiquidity, but certainly in this part of the world, the family offices are not at all interested. I think beyond that, the sovereign wealth funds are the obvious targets, but everybody shows up with a pitch book at all of those places. You can almost sit around in the waiting room and see all your fellow GPs. That feels like a pretty low probability outcome. So I'm sorry, I'm not being terribly responsive, but I just wouldn't put much time into it.
You haven't given me a country yet. Maybe I'll try Ian. Ian, you're not boutique, and you need capital to feed your funds and keep the machine going. What are the new places you're looking at? Where are you digging out capital?
Yeah, well, we're probably more focused on our traditional sources of capital, but there are new sources coming. Everyone's very aware of the plethora of pension funds from Korea that are launching into the market, and I think that's a very deep pool of capital. The pension funds from Malaysia are also moving into the market, and I think that's another deep pool of capital. I think the really interesting ones just haven't even started yet, and that is the pension funds of Japan, who currently virtually have, across the border, zero allocation to real estate, and the life insurance companies and pension funds of China. But as Charles said, you need to be very patient. There's nothing is going to happen there in any time soon or any short time frame. We're actually seeing the first tiniest little flow of capital from Japan, but not from traditional pension funds, but via their banking relationships. But it's minuscule. But the pool is gigantic.
Joshua, Charles mentioned family offices. PERE magazine recently reported there is a record number of billionaires in the world, about 1,200. And they control about $4 trillion worth of dollars, more than the whole hedge funds industry together. A lot of family offices in your country, of course. Are they a source of capital? Are they someone that you call on all the time? Are they getting together amongst themselves? What's happening with family offices?
Well, they're definitely an increasingly influential source of capital in kind of the private equity world, both in hedge funds and private equity and in real estate. they run the gambit of sophistication, but there are a lot of family offices that are very, very sophisticated. They're also very nimble, and I think that, going back to kind of timeline of decision making and relative to public pension plans that have to go through approval and regulations, et cetera, typically you talk to a head of a family office, or you talk to the wealth creator, and you can make a decision over dinner, right? And so that's encouraging. Talking about emerging markets, I think the family offices in emerging markets are probably the lowest hanging fruit. There's a tremendous amount of wealth that's been created in Brazil and in China with the individuals. Accessing those sources is much more difficult. It's interesting too when you look back at like Andrew's presentation and the last presentation about globalization of real estate. You look at these global sources of capital that traditionally have been invested mostly in their home countries, many of which are smaller and very, very dynamic. You looked at kind of the volatility in some of those countries of the marketplaces, and they have to go overseas. And the globalization of real estate, it's done in equities and fixed income. Real estate will get there, but it is going to take time, and that requires staying power through cycles like these.
Thank you. Any questions, ladies and gentlemen, before we move on? I'm going to move away from capital raising now and onto an issue that's been occupying a lot of people's time, and that's the issue of direct as opposed to indirect investment for large institutional investors. Tom, is this a real issue or a furphy?
Well, it's definitely happening. I don't think so. Certainly, it's a real issue. I think what you're seeing is there's a lot of investors which have the scale and also have the regulatory framework to do so are wanting to take matters into their own hands, and many are setting up their own platforms, which are basically doing the same role that many of us on this panel are doing. The big question, I suppose, is not a question about whether that is happening, because it certainly is happening now, but whether that is cyclical and whether it's going to swing back over time. I think for many of the large investors, they're very determined and they're building up highly professional teams. So, that they will certainly continue to be, successful in that strategy. However, that probably only works for the very large funds. If you go down to the large and the bottom end of large and medium funds, in order to get enough diversity into their portfolio, I think they're probably going to come back to funds, at some point in the cycle. I think the other impact that they'll look at eventually is they'll look at how many people they have in their headcount managing, for example, real estate, which actually will be, a fairly small portion of their overall asset mix, and then wonder why there's that disproportionality between the number of people managing that and the small allocation, and therefore it may swing back again.
So how large is large to be able to make the direct investment work?
Well, I don't think it's so much about the fund size. I think it's more about the real estate allocation. I think, and that also depends on how widely diversified that particular fund wants to be. So if you've got a fund that just wants to stick to a region, maybe that's a smaller size of real estate allocation. However, if they want a global strategy, actually you could probably count on both hands all the large funds that could, have a diversified strategy and sustain a large team to manage their real estate portfolio.
And has anyone done that successfully yet? Any large investor?
Look, I think, there's probably, without referring to individual investors, I think some of the Middle Eastern investors are setting up, the sovereign wealth funds are setting up very large teams. Canadian pension funds, for example, have bought into platforms, and they're clearly, galvanised in that direction. I don't think, for example, if you look at the US pension funds, I think, from a regulation perspective, it probably won't go down that path for them. Although, many of us would have read this morning about CalPERS buying into a North American manager. So it may take a slightly different form. But I guess the question is whether that trend continues and becomes embedded, or whether, certainly for the medium and large firms, not very large, it comes back to funds a little bit more. The reality is as well, I mean, you see players like Blackstone who are raising very, very large private equity funds. So there's clearly a demand in the market there. And, going forward, there's going to be less GPs to choose from. If you look at, those rankings of capital raised over the last 5 years for the top 20, there's actually quite a large number of those managers historically who have raised a lot of capital that will no longer be there in 2 or 3 years' time. They'll drop out of the league tables because their sponsors have changed strategy.
Ian, if we fast forward 5 years, what do you think the environment's going to look like with large institutional investors investing directly and funds? When you're bidding, do you think you'll be bidding against large institutional investors who have their own operation and are not using funds?
Yeah, probably. I think I subscribe to Tom's view that a lot of these people that think that direct is a better way to control their own destiny. It is an ideal way. Of course, it's the ideal way, but it's reasonably impractical for all but the very, very largest organisations, and so. Things will evolve over time, and there likely will be more of the really large organisations doing their own, but the vast majority of the pools of capital of pension funds and endowments and foundations and insurance companies, etc., will continue to require external managers to assist them. So even if they do their own, they may make their own final decisions. I think there'll still be a very substantial use of external managers. I do see right now, and I see it continuing, an increase in co-investments. So if an investor, an LP might make, if they have a $100 million allocation to a strategy in a region, they might put 50 in a fund and then make their own decisions on co-investments on individual deals in that fund with the remaining 50. I was just totting up in my mind, I think we've closed 8 transactions in Asia Pacific this year. One was a club, and that's another new format that we haven't discussed yet.
We'll talk about those in a moment, yeah.
Okay, so one was a club, one was just a fund on its own, and the other 6 were funds with co-investors investing alongside in each transaction. And for us, that's very new. We've only done one co-investment with a fund before this year.
Right. Joshua, when you talk to LPs, and indeed when I did a session here last year with LPs and GPs, we spoke about the most important things. And the list was the list of the most important things that LPs talk to GPs about, and the GPs should be talking to LPs about, not in this order, were fees, communication, transparency and alignment. And interestingly enough, at least 12 months ago, the view was that fees came at the bottom of that list and communication came at the top of the list. How do you think you would rank those elements now as being important to LPs?
Well, I think that all of those issues are all about alignment. I think LPs are concerned about fees because of alignment. They're concerned about communication and performance because of alignment. The institutional memory of what happened in the aftermath of the GFC is still very, very fresh in a lot of people's minds, and that I think is what's driving this pendulum swing for people trying to get more direct, more control, because a lot of people got screwed by the GPs. Today, as an investor, we're very focused on alignment of interest, obviously. And one of my colleagues in the States was telling a story about a fund that was raising, $1 billion, and they were putting in 1% co-invest. And they, and the investor was saying, well, that's not enough. And they said, well, it's $10 million. We don't have more than $10 million. And she said, well, then don't raise $1 billion. So, there's something to be said when the manager's got real skin in the game. I think that fees there's the whole fee sensitivity thing to me, and again, I'm conflicted because on the one hand, I'm beating up people on fees, and on the other hand, I'm trying to charge more.
This is why you're the ideal person for this
That's
question.
right. That's why I'm
you
sitting
see,
in the middle.
Because you beat yourself up. Yeah.
But I think that the fee discussion, I really believe it's somewhat a red herring. And I mean, we saw, and Andrew put up the data. I mean, you're looking at well over 1,000 basis point spread between top quartile and median performers. And, arguing over 25 basis points of management fee, I think is kind of missing the point relative to getting a real quality manager. And especially today, as capital raising is very difficult, you want your managers to be able to survive. And one of the things that's different in this cycle that we're really focused on is manager sustainability and viability, et cetera. And I'd rather have a manager charge a higher management fee if I felt that they were at least covering their costs, so that I would feel like they're making the right decisions versus trying to race out capital so I could raise the next fund. And
So would you be putting alignment of interests at the top of your list?
Absolutely. I mean, I think that is the core to make sure that your managers are effectively your agents for deploying your capital, and you want to make sure that they're on your team effectively outsourcing your capability to access the niche markets around the world.
Justin, if we take this theme of alignment, what does that actually translate to? What does it mean? How do you align with your investor?
Yeah, well, I think probably Josh has summarised it pretty well. But I think the other thing one has to look at is that you've got so many different investors with so many different strategies that I think they're going to look at things in a different way. Josh was saying, for example, that it's all about, obviously it doesn't really matter if you've got this range of returns, a spread of returns, if you have got an extra 25 points. But it's quite interesting seeing some other investors. I was at a conference where they had the CIO of APG speaking, where she was basically saying, well, look, we really want to get some consistency between all our asset classes and costs. The average cost for managing their investments across equities and bonds was 6 basis points. And that was the aim, what they wanted to do with their alternative investment classes, including property. You suddenly start thinking about that, and that's pretty scary, I think, for us GPs. So again, I think you'll speak to one investor and they're going to be very much saying alignment around fees is all about I want it back-ended. Others will be saying, no, I think it should be all about the quality of the transactions. We'll pay transaction fees, as, for example, German investors do. And that's, I think, makes it very difficult for us, particularly if you're talking about a commingled fund, when you're trying to get alignment. Because we take just fees again, you'll find that you'll have one investor saying we want it this way, we want it a different way. In terms of control, some will say, look, we don't want to have any sort of control because we don't do that as an institution. Whereas others will say we want veto rights. Others will say again, we actually want to be able to be involved in every major decision. So the alignment of interest, it might mean something to me, but it can mean many different things to our investor base.
So that then is calling on some kind of flexibility when you're talking to your investors as to what alignment actually means to them.
Absolutely,
Yep.
And I think that's one of probably the issues now with commingled funds. It feels like the last few years, and I think for some time to come, it's like trying to herd cats when you're trying to raise capital. Very difficult. Whereas often with a strategy where you're actually pursuing, say, discrete assets, where you're buying an asset on behalf of one investor, you've already agreed the alignment of interest, or indeed when you're pitching for a mandate. And so I think this also actually isn't particularly promising for LPs because there may be just a shortage of product coming up. Now, we're talking about 196 funds on the road at the moment, but it'll be interesting to see how many of them actually launch. And given the costs for failed launches for fund managers, are a lot of GPs going to say, look, let's just give up on doing commingled funds. We'll actually try working with one or two investors on mandates, whether it's a portfolio, or whether it's actually a single asset, or trying for, I just think just in terms of avoiding commingled funds.
We'll do a count and come back next year and see how they all went. Charles, just talking about structuring of funds, the discretionary blind pool model. Do you think that has had its day? Are investors still going to go for that, or are they wanting more? Do they want more discretion or more control?
Well, I hope it hasn't had its day, because that's kind of our model. As I said, we're a boutique, so a lot matters on who we are. I think one of the things that to actually, Josh mentioned something really important, which is a lot of manager and GP behavior in the last cycle that people are now reacting to. I think you can see the ripple effects of that, flowing through in a lot of the discussions that we're having, not only at this conference but other conferences. But on that point, I would say the direct investing model, which I think you've just alluded to, we haven't seen that movie play out fully, right? We're still in kind of the introductory stages of that, and if the law of normal distribution of outcomes kind of applies there's going to be some train wrecks as well. And so what may then happen is people will say, gee, maybe that wasn't such a good idea after all. They then retrench, come back to kind of the GP-LP model. Meantime, on the GP-LP relationship, the economic proposition might have moved substantially to benefit the LPs more. So you then have a convergence of these outcomes. So I guess to your specific question about structuring a fund, I would say, A, we haven't changed in our second fund. B, I think over the next 5 years we will see just how strongly some of these large institutional investors feel about kind of a go-it-alone approach. To the extent they want to get involved in GP level decisions as a matter of principle, I think that's a hard thing for me to figure out how it's going to work. I actually live in Singapore. I've been here 21 years. I've invested for 15 years a corporate balance sheet. I've been responsible for P&L. I have to assume, without sounding too conceited, that I bring something to the table there. And it's hard to understand why somebody sitting in Sacramento or Spokane, Washington, or Austin, Texas, can really bring an awful lot to that decision-making process, which we call pulling the trigger. And pulling the trigger is essentially what our business is about. When do you pull, when do you not? And I think to share that decision-making process, hopefully that's not too controversial, is something that I'm not persuaded about right now.
Tom, there's a lot of potential models out there and a lot of potential ways of mixing up the models. And without listing them all, we've got fund of funds, we've got JVs, we've got co-investment that Ian mentioned, we've got special situation funds, we've got clubs, we've got separately managed accounts, we've got hybrids, and the list goes on and on. If you, and anyone else is welcome to join in on this one, if you were going to pick a model that you thought will be the preferred model going forward, what would you, or what numbers would you choose out of that shopping list, or have you got your own list? What do you think is going to resonate with both the GPs and the LPs? Because it has to work for both.
Sure. Look, I think we've spoken a lot about sort of fees and now turning to structures. Essentially, what all investors want at the end of the day is performance. And to Josh's point on alignment, what they want to do is be able to deliver the best performance for the chosen risk strategy that they have in their portfolios. And I think ultimately in the long term, the selection of the right product is going to be that product best suited, or which has the best chance of actually delivering the performance. So I think funds, to Charles's point, do have a role to play, because you can essentially pool capital together, hopefully with other like-minded, limited partners, and underwrite a manager, once for each fund, and back them to invest on your behalf, hopefully for a good performance. You then need to overlay what other objectives that the investors have, and one of those, which I think is in a lot of focus at the moment, is liquidity. And obviously, blind funds are not the ideal vehicle if you're concerned about liquidity. So I do think there will be a role for other discretionary and non-discretionary mandates. I think the spectrum of those will run between I guess, a final veto where, there's certain liquidity issues with a fund and they just don't want to make investments at that point, or alternatively they want to control the timing of exit so to meet their own liquidity requirements in the fund, to the other end, which is that the fund itself wants to be closely and intimately involved in underwriting those deals. And I think in order for those funds to be able to sustain that and be responsive, particularly in Asia, deals move quickly. And you need to have the staff on the ground with the skills to be able to do that. And I think it comes back to the earlier point. There's only a very small number of very large funds that can sustain, high-quality real estate-focused teams that just focus purely on that segment. But like I say, I think there is still a role for GPs as, blind pool capital, but also other mandates running, the gamut of, different, from club deals through to separate accounts and certainly co-investments. I think all of those things will exist, but maybe the proportions will change. Right. Arguably, we could say we're at the smallest proportion at the moment for blind pooled funds, but and maybe that may increase over time.
Justin, fund of funds seem to have been going quite well. How does it work, or why does it work? So you give someone some money, they give some money to somebody else, everyone charges a fee. Why does that model
Crooks,
work?
they're all crooks.
I think the fund of funds is very interesting, particularly when you're going into emerging markets or for the investors markets which they're not very familiar with. So in other words, if you don't have the requisite knowledge, you need to really delegate responsibility to someone else. You're obviously wanting to get diversification, which you'll get through a fund of funds. I think what we've seen is it's been far tougher, particularly in Europe, for fund of funds to succeed, partly because of the vintages when a lot of the fund of funds went out. But I think also as investors feel confident themselves about investing in those markets, and they think, well, why can't we do that? We'll at least save the costs of at least managing that. I think probably that means why a lot of the fund-to-fund managers are also offering multi-manager services, so at least you're then getting something which is, again, perfectly aligned with your own interests, rather than saying we'll just go into a fund which then invests in other funds.
Joshua, yeah. What, out of that little shopping list, unless you've got others to put onto it, what do you see for the future as far as structures go?
Well, just kind of tagging on to what Justin was saying about fund of funds. I mean, I think that going to the multi-manager approach, just as an example, it's less about product today and more about solutions, right? I mean, the LPs have a very distinct idea of what they need in their property portfolio, and there's a million different machinations. And to the GP who can provide that kind of flexibility, they're going to be successful. Whether it be through a separate account or whether it be through a tailored approach, the liquidity issue that Tom brought up, I think, is a huge issue that if could be cracked, could unlock a tremendous amount of capital. So I think that the idea of going out with your pitch book and kind of pitching your product, it's very challenging today. If you can talk to LPs about what they need and be able to provide those type of solutions, I think you can have a much higher success rate by kind of putting the square peg into the square hole. But just tapping on one more thing just on the fund of funds model, because I think that, and it goes back to the whole kind of disintermediation, that, there are probably, and I don't know what the number is, but maybe there's 30 institutional investors in the world that could probably do it credibly direct themselves. And even if they could, it's going to be in the gateway markets. Like, I can invest in London, I can invest in Hong Kong and Tokyo and New York, but when you start going to, Brasilia or Bangalore or, some of these emerging markets, or even kind of smaller cities in major markets like in the US and in Europe, it gets infinitely more complicated. I mean, the reason why I think the fees are so high in our business is because it's an inherently inefficient business. And you're hiring professionals that have expertise in their markets and in their property classes to be able to access the best risk-adjusted returns. And I don't think that is going away. And I believe if we look kind of, 5 to 7 years from now, and some of these guys, many of the guys that have gone direct themselves, are going to end up with a similar feeling that they had investing in funds in kind of 2006, 2007, because arguably they don't have the talent, and they haven't been able to aggregate the platform to be able to do it themselves.
Ian, you have some special situation funds in Europe. I don't think you have any in Asia. Would that be right?
Not yet.
Not yet. What are they, and how do they work?
They're almost, I think I'm right in saying they're all mezzanine debt funds, which are looking to take advantage of the special situation which has come out of the sort of debt market liquidity crisis and refinancing non-recourse real estate loans and stepping in to provide mezzanine finance to existing owners or new purchasers. So I'm aware that there are other special situations funds which focus on niche markets and what have you, but our funds in Europe that you're referring to are all mezzanine debt.
Okay, thank you. Charles, anything to add to that model discussion as to what things might look like going ahead?
No, I maybe just to offer my own postscript on the fund of funds comments that have been made so far. I think there are two things that can be disintermediated. I suppose the most straightforward one is the economics, and I don't know enough about what's currently going on with funds and real estate. And then, of course, there's the whole knowledge, domain expertise, disintermediation that can occur simply by focusing on performance and the relationships that are developed with GPs. So finally what happens is an LP goes into a very, very well-run fund of funds, at some point finds himself talking to the GP that's actually managing money and distinguishing himself. And of course, I guess the natural reaction is on the disintermediation question, both economic and knowledge, do I continue to go with the guy that brought me to the party? I don't have the answer for that. I'm not in that industry. But in terms of the future, who knows? Hopefully we'll just get through this year. After listening to Ronnie's comments this morning, I think all of us need to go and have a drink at lunch.
Yes, a day at a time. Yeah. Well, what I'm hearing is flexibility. That seems to be one of the hallmarks, at least going forward. The need to be flexible, both from a GP and an LP point of view.
Let me just offer another comment. We talked about large investors wanting influence. I think what came out of the financial crisis, insofar as the discussions that I've had with investors is concerned, is that LPs don't see each other as risk-free relationships anymore. And there was a point in time, I think, when LPs saw themselves on this side of the table and GPs over here. So the table is three-sided now. There's kind of our kind of LP, and then there's that kind of dodgy kind of LP, and then there's the GP. And so it's a three-way conversation. Some LPs simply wouldn't go into a fund where that kind of an accommodation of a large institutional investor would be offered by a GP. In fact, they probably ask for representation right up front, that the discretionary blind pool classic kind of model is the one that's going to be stuck to. And if there's any deviation from that because the GP is tempted to get a big ticket from a pension fund, they're going to say, I'm out of here. So I'm not sure it's that straightforward. I think our ecosystem has changed, and so there's large kind of creatures roaming the savannah now, the big direct guys, and they may have to carve out their own space and their own type and breed of GP. I'm not sure they will coexist with the smaller family office and maybe less worried LPs about those LPs that are less worried about control.
Okay, so staying. Yes, Justin. Yes, please go ahead.
No, I think one of the interesting things is we've talked very much about the unlisted route, and I think we need to look at the listed route. Because you said it's incredibly difficult to raise capital. And particularly if you're going out there doing opportunistic funds, you've got a 5-year life or whatever, and you've got the whole process going again. I think that's going to be very interesting in terms of REITs, about the popularity, if you like, from a GP. You get permanent capital. And I think then from the LP's point of view, they've got flexibility, which is what we've just said, everyone's flexibility. You've got liquidity, you've got the ability to the speed to actually get money invested into particular markets, and particularly markets perhaps where the emerging markets where there's a natural attraction to go into the listed route. Obviously, there's lots of disadvantages going through the listed route, not least the problems of correlation with equities. But I do see REITs as being, again, becoming very popular.
Yeah, that's that's interesting, especially with markets maybe one day emerging, REIT markets maybe in the Philippines, already emerged in Thailand, their brand new legislation, Australia, India, of course. People are talking about Pakistan, even China maybe one day. Yeah, another interesting source. Just working my way, Charles, from you back. If you're in an elevator and you're going down with an LP, what is the singular most important thing he wants to hear from you to get him to write a check, him or her to write a check? You've only got about 15 seconds.
Yeah, okay. It's like a 10-floor ride. I was here when we started the business. I'm going to be here when we harvest the capital from the fund that you're investing in. And I can tell you that there's a lot of LPs, when they look at the relationships they've had with GPs, and I think we all know in this room that this year has been a year of great turnover and change in the GP and the platform space. And frankly, there's even a sponsor here of this conference that has been in kind of market talk about change of ownership. I think investors want to know who's managing their money, because it's a 6-7 year commitment. I mean, it's really a remarkable industry when you think about it. You're asking people to manage their capital for a period of time when, if those of us who have children, and they go from 9 or 10 years old to graduating from high school. I mean, think about what a big span of time that is and what can happen in the external environment. So we ask people for that discretion and that trust. I think they want to know that the guy who brought the money in is going to be there when the money's given back.
You've gone up and down a few times now, but you're going for brand and reputation. What about you, Ian? What are you going to say in your 15 seconds?
Well, I'd certainly endorse what Charles just said, going up and down the elevator. But then I would point out that there's a great deal of dislocation in the capital markets, which on the one hand is making it very difficult to raise capital, but on the other hand is creating opportunities which I don't think we've seen for a while. I mentioned earlier raising capital in 2000, 2001. The opportunity to deploy capital, in my mind, is very, very similar to exactly then. And certainly from my firm's point of view, that particular fund's the best performing fund we've had anywhere, anytime. And I see that opportunity substantially repeating itself right now.
Yeah, so you're going for brand and reputation as well. What about you, Joshua?
I have 30% of my liquid net worth invested in this fund, and not just because it's good alignment of interest, but because I believe it's the best risk-adjusted return of the asset classes out there today.
So you're big on alignment, yeah. And Justin, what about you?
Yeah, absolutely. Alignment, I think, is really important. But I think Josh probably summarised it. Alignment actually encompasses almost everything.
Yeah. And Tom?
Well, I think there's little to be said after all that. But I suppose the other thing that I would add is that, certainly our style is one of boots on the ground operator model. So we run a fairly expensive platform, but we have real estate professionals on the ground in the markets that we want to invest in. That's
Operational as opposed to allocator model. Is that what you're talking about? Can you just give us a couple of seconds on that, because that is interesting.
Yeah, I mean, I guess our model is to actually have offices in all the locations largely that we invest in, and so when we're sourcing deals, when we're asset managing deals, there are local teams on the ground who are identifying those deals and managing those deals through to exit. So it's for us, we believe that's a very important factor. And but I think it does come back to, if you're talking about raising capital, it's about reputation. And I think importantly now, it's understanding that we've actually been through the cycle, and we've all learned lessons as we have, and demonstrating that those lessons have been well learned and understood.
Some of us have been through more than one, and more than two. Ladies and gentlemen, any questions? Because we are out of time. No? Seeing none, please join me in thanking our panellists.